All right, this is a slide that I did about 6 years ago. Not even that, I think 4 years ago, four or some 5 years ago, I'm not really sure, but a lot of the stuff that's there has been valid for the last 400 years because people have been using the same techniques, same everything forever. I'm going to quickly, you guys already know a little bit about me. I'm not going to go and bore you with that because we are very, very short on time. I'm just going to start with what is chart analysis, right? So technical analysis or chart reading is basically forecasting of future financial price movements. You want to see where an asset price is going in the future. You can't predict it, right? Nobody can predict it. Nobody has a crystal ball. But what you can do is you can look at the past prices, how the stock has been trading or an asset class has been trading over a period of X amount of time. If you're looking at the 5-minute or very short term, then you're looking at the obviously short term, and then you can predict in the next whatever amount of time where you think it's going to go. We're trying to predict where things are going to go on a yearly time scale, much longer time frames. Okay. By the nature of the fact that you are looking at history to predict the future, it is not a leading indicator of any sort. It is a lagging indicator, right? Because you're looking at the past to predict the future. Now, when I use the word predict, you're not predicting the future. What you're doing is you're looking for early signs of things changing, and you are reacting a little bit earlier than other people. That's all. There is no such thing as predicting anything unless you yourself have enough money to move the market. So let me give you a different example that I give to people. Let's just say that you are
access code by the pound or hash sign. The recording has started.
Okay. I have to mute the person, but okay, let's continue. So if you guys can still hear me, everything's fine. Just let me know in the chat. Okay. Because there's a lot of other people that have joined, time is very important for them. Let me go over some other things, okay? Why, I'm not going to get into the debate of why technical analysis works, why chart reading works, why it doesn't work, but I'll just go over quick topics on. It's a 400 years old technique. It's still used today. Every major hedge fund company has a technical analyst on their team. And it's not a silver bullet. It's not the only thing that's going to help you maneuver in the market. And it has its flaws, it has its drawbacks, and it has its strengths. Okay. There's one very important thing which most people forego when they're looking or thinking about technical analysis and why it works. In the United States, in any major market, in the Western world, anywhere where there's good financial practices being followed, anytime there's a publicly traded security, like a publicly traded company, when there is a trade on it, on its shares, it has to be reported, right? It has to be reported through FINRA, trade reporting systems, etc., etc. So every time there is a lot of movement in something, because it has to be reported, you can analyze the tape and know what's going on without even knowing if there were, without even paying attention to every single piece of news about that specific asset class. So I will give you an example. If you see, so these are called footprints that you're studying in the market, right? When you see these footprints, they are embodied in a chart, in a price chart. That's why I start everything. I start all my analysis from a simple chart itself. The reason is that you could be right on a lot of things, but if the people that actually have the money and capacity to move the markets they don't jump into the asset class to move the stock. You can sit in the stock for 10 years and it's not going to go anywhere. That is why you always start with the price chart. You can have the best investments of your life, right? You can be in it. It may not move and you may get tired and you may get sick of it and move out, right? The other thing is, this is a law, right? Trade reporting within the first 10 seconds, 15 seconds, whatever the time frame is, pre-market, after-market, right? This is a law. This is a U.S. law. This is a law in the UK. It's a law in all the free markets. So wherever there's trading on the free markets, everything has to be reported. Every country jurisdiction has their own setup where they must report these trades. So you can look at a price chart of, let's say, a stock trading in Shanghai, and be confident that you are getting the actual picture of what's going on. You can also look at the chart of Amazon here and you know what's going on, right? Just by looking at the footprints. So as technicians or as somebody who's looking at clues about the market, this is the analogy I give people. Sorry, I'm just dragging it on, but this is an important point to understand. Because people say, oh, how did you know that this was going to drop? How do you know this is going to go up? These guys they have no idea. They have no clue about what technical analysis is and how it's used as a tool. So imagine you're a bee, you're a small fly, and you're sitting on an elephant. So these elephants are these big, huge hedge funds or mutual funds when they decide to take on a position in a specific stock, right? So let's just say that ARK Invest decides to take a position in a stock in Aqua Bounty Technologies, AQB, and you decide that you want to get into it. You can actually look at the stock, look at the volume profile of the stock, and know that there's something going on just by the sheer amount of volume that's increased in it. And because they have to report all these trades by law, they cannot go and trade outside of it. Even if they do a block trade of many millions of shares, they still has to get reported, right? So you will still see that print. So as a fly that's sitting, your job is to basically watch for these elephants move. And when these elephants start moving, you basically fly and sit on their back. And then you ride it as long as they're moving. And when you fear, or when you detect that they're now about to sit down, you fly off, right? So yes, this is as simple as that. So technical analysis is always going to be lagging. You are not going to be leading. Somebody big enough with a lot of money to move the market has to move first. So you're going to miss the first 5%, 2%, 10%. What you're trying to do is, once it does that initial push, and in the first pullback, or when it's actually moving, there's two ways to get into it. Yeah, that's when you basically ride that wave in. This is for technical analysis now. For fundamentals, there's other ways and techniques we can cover. Like everything else, there is, I'm going to cover I'm going to divide this whole presentation or talk in two sections. First section, I'm just going to talk about the building blocks of chart analysis. And the second one, I'm going to look at a few charts, okay? So you can go to TradingView.com. If you go here, you're going to go to this main page. You're going to type symbol, SPY, and it'll give you a chart. You can click on full feature chart, and it will bring you to a chart like that. You can adjust how that chart looks like by going here, changing it to, if you want it, the status line, whatever changes you want to make to it. You can make it into a candlestick. You can make it into a line chart. You can make it into a bar chart. I like to keep it to candles because it gives you the most amount of information. Now let's cover something quickly. What are the building blocks of a chart? Okay, so the basis of technical analysis is that price discounts everything. All the information that you see that everyone in the market knows is already discounted in the price itself. Okay, I believe that the price movements are not random. They're not following a Brownian motion. A Brownian motion is a totally random form of movement. I don't think they're following Brownian motion. They are non-random. If you believe they're random, then you're wasting your time, because don't even look at the chart. If you believe that price movements are random, this is not the right tool for you. A lot of technicians, people that are looking at charts, they like to say that what is more important to them, because obviously you get paid on the price. Let's go back together. Okay. So let's cover some basics, right? Just like when you build a house, you have to dig, you have to form a basement, you have to put gutters, you have to put pillars. On those pillars will go your frame, and on that frame will go your house and the other parts of it, the roofs, the floor, and then you'll have the outer shell, then you'll have the siding, then you have the roof put on, okay? So just like that, for chart reading, the basics of chart reading are these individual candles. You need to understand what these individual candles are, right? So there's hundreds of courses outside. My job is to get you what you cannot get from outside, right? So I'm going to teach you my method of doing it. So my method is, first thing I do is I look at it. The fundamental building block of a price chart is a pivot. What is a pivot? A pivot is basically a point from which the asset price stops moving in a certain direction and moves in the opposite direction. So let's just take an example. Let's take an example, a pivot. So here you can say that stocks were moving up and they were going up and then it reversed, right? So at this point, we have pivoted down and now we're moving down. So I know now everybody is going to be like, well, what about this section over here? What about this section? When do we actually determine? This is the most important thing, right? So for a building block, when do we actually determine that the price has actually pivoted? So the rule to know, and this is very important. I can record it for you. You can you can talk to me. You can be on the Telegram channel and talk to me over there, and I can explain. So as long as prices are going up, you're in an uptrend. When you have the close of, let's just say it was September 3rd, and then when you have the close of that day below the low of the previous day, then you can say that we have pivoted down. We are no longer in that trend that we were going in. Okay? Same thing. It has to close below the low of the previous day. It cannot close below the close of the previous day. It has to close below the low of the previous day. So if you look at this candle, the low of this candle is at 353.53. And this day it closed at 345.54. It closed below the low of the previous day. Let's take another example. So here, if you look at prices are going sideways, so they went down. This candle, the green candle, closed above the high of, so at this point, when it's going higher and higher, have we pivoted? We haven't really pivoted. We opened here and we closed here, right? So at this is the day when we pivoted. We didn't pivot this day because this is the day when we closed below the low of this day. So now the prices are trending down. This is as far as it went, and then the prices went up again. And when they went up, the close of this bar was above the high of the previous day. So this is a very important concept to understand. So that is pivots for you. It could take many days for the pivot to form. It could take 2 days or 3 days. But again, go with the rule. And I created this rule for simplicity's sake so that everybody can understand and follow along. Because there's a lot of times people will get confused on, okay, so how do I know that the prices have actually pivoted down or pivoted up, or how do I know it's an uptrend or not? So yeah, it's pretty evident here that we're going up, right? At this point, on this day, this is the day when prices closed below the low of the highest candle. So as long as we're going up, this was the low that day. We didn't pivot below. This is not the day when we pivoted. This is the day when we pivoted. So it came a day after. On this day, 3/19/13, it closed below the low of the day on 8/2/20. Okay, so you guys can have questions about it, and we can discuss this a lot. Number two. So I'm going to go to number two. Point number two. This is what an increasing or decreasing bearish candle is. So number two is when you look at a chart, when you take these pivots, and you join them together, you create what is called a trend line. Okay? Joining these trend lines together will give you some sort of a trend. You can easily identify what trend is happening based on once you join the pivots. So if you guys want to unmute your mics and talk to me right now for 2 seconds, and if you have any questions, I can cover them right now. So if you look at this price chart, right? So let's look at this. Here, you see a pivot here, you see a pivot here, a pivot here. This is a pivot. So you can draw from pivot to pivot, and this is your trend line. There's no right or wrong answer in this, right? You can draw a trend line like this. This is your trend line, and this is your uptrend. This thing broke through your uptrend if this was the trend line that you created, right? For a trend line to be valid, it has to have 3 touch points. So here's one, here's another one, here's another one, here's another one. So this is a long 1, 2, 3, 4. I mean, you have 4 touches on this point. And we broke through this trend line. Okay. Anyways. So somebody can argue, well, this is very subjective. I want to draw my trend line here. Well, okay, you can draw your trend line here, but there's only 1 touch point on this trend line. And if we bounce off here and we touch it and we go up again, yeah, then this becomes a valid trend line. But okay. Anyways, so what's more important than and again, I'm rushing through them. I'm only covering the most important concepts just to give you a little bit of just getting your toes wet about reading a chart. The other thing I talk to people about is, and very important, is a support and resistance level, right? A support or a resistance level is so what is a support level? A support level is a place where people will normally step in and buy the stock, right? So if you look at the stock, if you look at SPY, the question, okay, so everybody will tell you, you can go to the web and you can think about it. People will always tell you, oh, support level is a place where all the buyers come together, and this is where they normally want to buy. Or people have memories, and there's a psychology, and then because they have had, these are pain points, and everybody remembers this, at this point there will be break even, or blah, blah, blah. Everybody has different reasons. My reason for why support and resistance is at the points where we have them is because of fundamental analysis, okay? Let's say you are a money manager managing billions of dollars, and you like to buy S&P when the PE ratio is 16 or 17, right? So every time, because look, people that have tons of money, they don't do technical analysis like the way normal technicians do, because they themselves are the elephant. Remember how I talked to you initially about the elephant, and you're a bee, you want to sit on the elephant. When the elephant moves, you just basically ride with it. When it's sitting down, you sit down, right? So people with a lot of money, they can't do this, right? Because they themselves are the elephant. They can only talk to other elephants and say, hey, listen, what are you going to get into, or what are you doing? You know, they can feel it, but they basically move on fundamental basis because they have so much money. And when they start buying, their buying goes on for months, okay? So let's just say that the money managers, they say, well, I want to buy it when it's at a PE of 14 or 15. This is why, based on the economic conditions or based on whatever the picture is, they feel like they don't want to pay for anything over 15 PE. So every time it hits 15, that's the time that this gets supported, fundamentally. Now, once they support it at that level and it goes up, the other guys, the small guys, the technicians, they also jump in and they say, oh, wow, it was supported at this level. Guess what? I'm going to also buy at this level. So then it becomes a self-fulfilling prophecy when every time it comes here and it goes above, right? But the fundamental guy actually supported it at this level, supported at this level. So the first dip that happens, the first supported dip is actually done by the guy with the big bucks who's done his fundamental analysis, who's done his macro analysis, and has decided that he's going to support it, or they have decided that they're going to support it at this level. Okay, so that's why these pain points and these price points, they actually work. So, and there's the thing. So, and then this is the thing too. So if you decide that they can also decide, hey, I don't want to pay for the stock more than this specific price. Okay, I don't want to pay for this more than this. But then something else can happen. A lot of things can happen. So let's just say that if you, and just like you have support, right? You have resistance zones, right? So this is a zone where we had a lot of resistance on Zoom stock. Okay, the earnings came after. Look, the earnings came after, but even before the earnings came in, people that have done their work on Zoom, they're not looking at charts, only charts, right? So this is the point where it, above 166, it had problem breaking through. So it would come here, it would get sold off. Because again, you know, the guy that did his analysis was investing billions in Zoom. He doesn't like the stock before that. But then why does it break through the resistance and punch through it and continue higher? Because obviously with time, things change. And when things change, this resistance no longer stays in effect, and the stock punches through and goes higher, especially on higher volume, right? And then you find out, look at what this is happening, and then you find out a couple of days later that, oh wow, the earnings were awesome, and the stock is up like a gazillion %. Okay, but that's not the matter. The fact is that the elephants supported the stock before the earnings came out. They knew that fundamentally the amount of money Zoom is going to be making, the outlook has changed for the stock, and they're supporting it, right? Little guys can't do this. Little guys can't punch through resistance levels, okay? What can you do at this point? You can chase it over here, or you can wait for the first pullback at the support level, and then go higher, okay? So I've covered the second point. Let's go to, covered trend lines, I've covered support and resistance levels. Then let me tell you a very, very important concept. So people will tell you all the time about this is a double bottom, this is a triple bottom, head and shoulders, this is a triangle, ascending triangle, all the BS in the world. That is something you can work with if you like. I can give you a simpler alternative to think about. So the simpler alternative to think about it is, look at it this way. Stocks are always going to be either oscillating, right? They're going to be bumping up, bumping down, bumping up, bumping down. That's because the people that are sitting with cash, they need a good reason fundamentally to push this higher. So obviously either the earnings have changed, the amount of money they're making, either they adjusted their bottom line or the top line revenue numbers, because of which stocks are able to come out of it, right? Otherwise it's always stuck. Now, the range is not always, the oscillation is not always, it can go on sideways for a long time. It can be, it can squeeze in together for a short time, making a triangle shape. It can make donuts, it can make all kinds of shapes. But the basis, right, if you're new to this, just remember, stocks do two things, right? Or all asset classes do two things. They're oscillating, the trading range, or they're trending. Once they're trending, they don't trend forever. Then they go into oscillation, then they're trending again. Then they go to oscillation, and then they fall down or they go up, right? So once they come out of this range. So this is the third most important concept. If you look at any chart, right? So if you look at any chart, let's look at, give me a chart, guys. What chart do you want to look at?
Kroger, KR.
Which one? KR?
Yes, or the Kroger.
Kroger, KR.
Yeah.
KR. Okay, Kroger. Let's look at Kroger. All right, so let's look at Kroger. So what happened to Kroger? Kroger is a very busy chart, right? So again, same thing with Kroger, right? This is the range, right? If you look at this range, This was the range it broke out of. Once it breaks out of this range, it comes back and tests it, and now it's trending. It's trending. It's again, it oscillates for a little bit. Here's the oscillation period. Here's the trading range period that you're talking about, that I was talking about earlier, right? Then it breaks out again, right? So now again it's trending. So look at this again here. So these patterns are forming, right? The oscillations are forming because somebody is doing fundamental analysis on this. What price do they like the stock? Yeah, I like the stock at this price. Yeah, it goes up. Okay, nah, it's too expensive. I don't care. It's gone way out of. I wouldn't pay this much money for this kind of stock. So then they sell it off, right? Obviously, some things change, and then just like how they break out, they also break down, right, from this range. So any stock that you see goes from a consolidation to a trading range, consolidation to a trading range, consolidation to trending, consolidation to trending, right? So now it's trending down. Every stock does the same thing. Okay, this is a very important concept. The stocks don't do anything else except these two things. They're either oscillating, trading in a range, or they're trending. Most important thing, if you want to buy a stock, you always buy when it's breaking out of its range. When you can buy, if you want to buy a stock when it's oscillating, you buy when it's at the bottom of its range. If you cannot identify what the range is, you simply wait for a range to be established for you to take a position. Okay? You never buy the first dip. You always buy the second or third. Okay. Continue on. Okay. So the third most important concept. So I covered price pivots, trends, supply and demand, consolidation, and the third thing is if you want to look, when you start looking at a price for something, you always want to look at, the first thing you define when you want to start trading is you look at what time frame am I going to trade this in. If you are trading it, if you're investing in it, are you holding it for 5 years, 2 years, 1 year, whatever? Just be honest, right? Are you just in it to make a quick buck and get out? Hey, there's nothing wrong with that. But be very clear on what you're trying to do. If you're trying to make a quick buck and get out, fine. Then you are going to be playing with a different set of rules. Once the stock breaks your stop loss, you're going to get out. Okay? If you're investing, then you're getting into a stock based on fundamental reasons. But at the same time, even though you're getting into the stock based on fundamental reason, you're not just jumping into a stock. Once you decide, oh, you know what, Tesla is great. Oh yeah, I think electric car companies are the next thing in the world, and everything's gonna just, you're not gonna do that, right? It doesn't mean that one day you just wake up and you just buy the stock here. You don't do that. I have a video of how I explain how to enter assets at the right time, at the most optimum time. So the analogy that you have to understand is that, let's say you're rock climbing and you start putting anchors every time you make a certain amount of height when you're climbing. You basically put anchors in. So if you fall and slip, you don't fall and slip hundreds of feet. You only fall and slip like maybe 20 feet. So let's say if I had bought Tesla here or here and it fell through, right? It didn't continue going up. The only amount of money I would lose is from here to here. The only amount of money I would lose is from here to here, right? But if I bought something which is already in an uptrend, which has been trending for a while, if I catch it in the middle, I can be lucky and it can go up. But if it goes down, I have no idea what to do. And this is the most common question I get from people. Oh, I bought this based on some guru that told me to do this, or it was an alert or something happened. And I read a news about it or something, whatever, or somebody gave me a tip. And I jumped in. Now I'm in trouble. What should I do? My response to them is, well, if you when you enter a stock, that's the time when you need to know what is your exit if it doesn't go in as how you planned it, right? So if you got into the stock here at 445, what are you thinking? Are you thinking it's going to go to 575 tomorrow? Well, okay, if you got into it based on the fact that Tesla was going to get added to S&P 500, the day the news came out and it wasn't added to S&P 500, and the stock pivoted down. So this is the highest high that it ever made, right? This is the day when it completed the pivot, right? Because it closed below the low of the previous day. And now you have the news in front of you that it's not added into the S&P 500. That was your catalyst that got you into the stock, right? So you can get into a stock based on either a fundamental reason, a news event, or just simply looking at the chart, right? Or just simply looking at technical analysis, right? So the last time I bought Tesla was at this point, right? And the reason I bought Tesla at this point was, again, if you refer to my video, I explain how do I do it? Like, how do I actually time my buys for my long-term investments, and then how do I add positions to them, right? So the first time ever, I sent out an alert, or actually I bought calls in Tesla with December 13th, right here. This is the point, I think. This is the first time I bought calls in here. And this was not magic. This was just based simply on the system that I followed, right? I followed the same system. Second time I told people, or I was buying, was here. The third time here, fourth time here, right? Now, this is when I get the most amount of calls from people. Wow, should I get into Tesla? Should I buy Tesla? Should I buy Tesla? Should I buy Tesla? Right? And I can't tell them yes or no. I have no answer because I cannot look into the future. I cannot look into the future and tell you what's going to happen. Can it run up for another couple of days? Hey, look, if I told you on this day that when it was trading at 394 and don't buy it, right? Because the next drop, the last anchor point is 30% below, right? This is the last anchor point. This is the last anchor point. But the stock continued going up, went up another 20%, and then it reversed, right? I don't want to keep you out of your winnings, but that's not the prudent thing to do. And that's not what I advise. But you can do what you like. So now number 3, let's cover. I think I've covered most of the points. Now, if you are trading for long term, then give me a stock that you guys want to get into long term. Let's just say that I wanted to get into Apple. I don't like Apple, but let's just say that if I wanted to get into Apple, and if I was investing in Apple, I would look at 2 charts for Apple, right? I would look at the daily chart for Apple, and I would look at the weekly chart for Apple, right? Because the weekly chart tells you a different story, and then the daily chart. So whichever time frame that you are trying to trade in, if you are a short-term trader, you want to hold your position for maybe 2 days and 3 days, you want to take your money and run, then what the 2 charts that you should be looking at is a daily chart, right? And you should be looking at an hourly chart or a 30-minute chart, right? A 30-minute chart will give you a sub-trend, or it'll give you information at a much more granular level than the level that you're trying to look at. So whatever time frame you're trading in, you look at that time frame. So if I look at Apple, here, and so from here, the other thing is, let's say if I was just looking at this, from here, it looks like, yeah, there's support here. If I was looking at if I was only trading it for a couple of days, I would look at the 30-minute bar, and from what it looks like, it's like, oh yeah, there's support here. Look, there's this big beetle, there's this area here. looks like there's good support here. You know what? This is a great place to buy Apple for me right now. Right? This is what I would be looking at. I'm going to buy it here. It pops up, and this is a good area to buy. But before you jump in, also switch to a daily view and see what's going on. Now, if you look into a daily view, you kind of are, it's like, whoa. So it hasn't been supported yet, right? So it's still trending down. It hasn't pivoted up, so I wouldn't get into a stock unless it pivots up. It's still in an uptrend. The uptrend can be broken, and or not, right? It might be a good day. So I would wait for the day when it actually pivots up. So if there was a green candle here, it turned up, close above the red, that's the day that I would get in. And I need to see the volume go up that day, right? Low volume, if things go up on low volume, that's not a good sign. Now, the last thing that I want to show you is, so when you look at the chart, right, it should be very clear and evident what's happening with the chart. If you don't understand what's happening, that means you don't do anything yet, okay? It has to jump out at you, and if it doesn't, then it's not the right chart to trade. It takes practice. Now, there's a lot of people which will sell you a course, and they'll tell you they'll charge you thousands of or hundreds or whatever, you know, and they'll tell you that I'm going to teach you how to trade. They can teach you everything that I'm teaching you or telling you is openly available, and you can go to stockcharts.com and you can go to Chart School. You can go to chart analysis, technical, every single thing that you were talking about, that I'm talking about. You can go to chart analysis. You can go to what are gaps, what are gap analysis. You can read about every single thing that I'm telling you. If you want to read about chart patterns, you can go read about chart pattern. What is it? Why do they work? You know, and like you can read a lot of information. Everything is there. Now, what I cannot give you, or nobody who's teaching anything can give you for any amount of money, is the experience that they have. Okay? I cannot make you as good as myself or as bad as myself, right? Based on whatever the experience I have. Nobody can do that. So they're charging you for something which is free, which can be accessed from here. You can go to YouTube and look for a few training videos. You're going to find a bunch of guys that are doing this for free. You can learn all of this, right? The fun is not, you don't make money by just watching the videos, right? You make money by practicing. So once you start practicing on charts, you bounce ideas on people, that's when you know. And the third most important thing that, so I've talked about, I think most of this.
Ruslan, can I ask a question? I made an observation on Apple chart. I have a clarification.
Yeah, if it's about specific assets, let's hold it to the end. Let me just finish the basics, and then we might take that question in the end. Okay, so the third thing, so I talked about pivots. I talked about either stocks are trending or they're oscillating. I talked about support and resistance. I talked about trend lines. And then another thing, very important thing, is moving averages. Now, which moving averages are you guys going to use? You guys are going to use the 20 moving average, 50-day moving average, the 200-day moving average. Right? For beginners, these are the moving averages I would tell you to use. So you'll use the 20-day moving average, the 50-day moving average, and the 200-day moving average. Now, every time the stocks touch the moving averages, things happen. Why do they happen? Because there are other people who are also looking at this. It's become a self-fulfilling prophecy. Everyone's looking at the same moving average. Look at how many times it touches the 200-day and goes up. So when something is in an uptrend, the bigger the average, the less frequently it's going to be visited. And the smaller the average, the more frequently it's going to be visited, right? So if you're looking, try to get into, if the market is in an uptrend and you're trying to jump in, it's not going to come into the 200-day moving average, right? It's going to come to the 20 or maybe the 50, right? That's your chance to get in, fine? Now, if you're adding to your position, these are points where you can add. Now, watch the video that I did earlier, which explains how do I pick the most optimum times to add. Now, if you're looking at big monumental moves, then you have to look at the 200-day or 400-day moving averages. Okay, this is where the most and the biggest stuff happens. Once, if something's trading above the 20 and the 50-day moving averages, it's in an uptrend. Simple as that. And again, I covered this part in another video, so watch that video if it's important for you to understand that part too. Actually, that video is a more this is what I'm talking about is a prerequisite to that video. Some of the things I cover in there, a lot of people ask me questions like, well, we don't understand what you're saying. So these are the basics, the fundamental building blocks of things that I use and talk about in the second video. Right? That video is more interesting and exactly what you really need. So I think I am done now, and I want to show you one more thing. Do not use 50 indicators. Okay? There's no goddamn indicator in the world which is going to help you make money if you don't know how to use it. If you use only one indicator, that is absolutely good enough. Like, so how many things you do? You know, how do you do a pivot? How do you know if prices have turned up or they've turned down? Right? They can turn back up again. That's okay. But you must know when have prices actually turned in a certain direction now. When has the momentum changed? Number 2, support and resistance, trend line. Number 3, either they're consolidating or they're trending. Okay? And whenever they're consolidating, they're making all kinds of chart patterns. Okay? They're making bears, this, that, whatever. They can make a boat. They can make head and shoulders, whatever you want to call it. This is a triple bottom. Who cares? They're just consolidating or they're trending. Okay? Keep it simple. Then there's moving averages, which people use adaptive moving average. When the 18-day crosses the 45-day, just forget all that nonsense. No. Stay simple. Use the 20 exponential moving average, use the 50-day moving average, and use the 200-day moving average. This should be enough for you. And the third and last thing that I'll tell you, and this is very important, is if you want to use an indicator, I showed you how to use the 20-day rate of change. Now I can get rid of this guy, and I can add the MACD. Okay, it doesn't. I'm just giving you an example. Okay, now for MACD, if the blue line is above 0, we're trending positive. It's below 0. Don't invest in stocks right now. It is that simple. Well, what about the time when I was here? I could have missed this move. Yeah, but you could have also had your head chopped off too, right? If good thing it turned up and the Fed started printing trillions. Otherwise, it could have dropped like 1999. Okay, so don't worry about it. If you lose you can't time. Nobody can time this. Okay, you can't time it. You know why? Because you don't have the big bucks to go and move the entire market. You don't have the billions and trillions in your account to move the market. So the big boys are going to move and lift it up. Once they lift it up, you as a bee are going to see, well, the elephants have picked it up. Now it's definitely about 50. This is a good entry point for me. I'm going to get in. Oh, well, if you miss this entry point, just wait when it comes back to a 20-day, 50-day, or it could touch these, right? So if you wanted to add, this would be a good place for you to add a few stocks, but that is if it goes up. Now, if you're trading and it turns down again, you only lose money from here to here, right? So let's just say that if this thing turns up again from this point, you can get it over here, and this would be your stop loss, right? Which would be like 5% or something. Now, if Apple turns down more, right? If it was a fake rally continuation and it turns down again, guess what? You're only going to lose a little bit because you entered at a good safe point, right? You dismount at a safe point and you mount at a safe point. So can you ride a horse when the horse is in full gallop? No. You can. I mean, you might hook it and you might ride it for a little bit, but you can get your face ripped off too. Both direction. So I think I am done. So the only technical indicator you can use as a beginner, you can use the MACD. How to use a MACD? Is the blue lines above 0? It's positive. Blue lines below 0, it's negative. You don't need any expert or anybody in the world to tell you if the market is trending bullish or bearish. Market is bullish, Market is bearish. Okay. Market is bullish. Market's bearish. You wouldn't wait till here, but you would get out. If you were trading, you would get out on a break of the 20. Again, we can cover that more in detail, but this is the easiest way to tell you. And again, if you would want to use a combination of the daily and the weekly, right? If you're trading for maybe a couple of years, if you want to hold a position, you want to look at the daily chart and you want to look at the weekly chart. If you're only trading very short term, look at the hourly or the 30-minute chart and look at the daily chart. So you, whatever chart that you want to trade in, look at one chart level higher, just to confirm the trend in both. So I think I'm done, and I'm going to